In the heart of Wall Street's financial empire, amidst the glitz and glamour, lurked one of the most infamous figures in modern financial history, Bernard Madoff. Once hailed as a Wall Street icon, his name would become synonymous with deception and betrayal. Bernard Madoff, the mastermind behind one of the largest Ponzi schemes in history, led a life of prestige and power. His investment firm, Bernard L. Madoff Investment Securities LLC, promised investors consistent, high returns. But behind the facade of success lay a web of lies and deceit. In 2008, the world was rocked by the revelation that esteemed investment advisor Bernard Madoff had orchestrated an elaborate Ponzi scheme, causing catastrophic losses for investors totaling billions of dollars. The Madoff investment scandal stands as one of the most significant financial frauds in history, leaving a lasting impact on Madoff's victims, the financial sector, and investor confidence. In this exploration, we delve into the rise and fall of Bernard Madoff, dissecting the intricate workings of his fraudulent scheme and examining the ripple effects it had on the financial landscape. Moreover, we scrutinize the aftermath of the scandal, shedding light on the legal proceedings and regulatory reforms that followed in its wake. The Madoff investment scandal serves as a cautionary tale, highlighting the importance of vigilance and due diligence in investment practices. By understanding the red flags and warning signs associated with Ponzi schemes, investors can better safeguard their financial interests and avoid falling victim to similar fraudulent schemes in the future. Bernard Madoff, born in 1938, embarked on his financial career during the 1960s, marking the onset of what would become a storied journey in the financial sector. By the 1980s, Madoff had established Madoff Investment Securities, a brokerage firm specializing in options trading. His firm's success catapulted him into prominence, earning him widespread respect within the financial community. Beyond his brokerage endeavors, Madoff ventured into investment advisory services, laying the groundwork for what would eventually become the focal point of his notoriety. His investment advisory arm catered to a diverse clientele, including individual investors, charitable organizations, and financial institutions. Bolstered by his reputation as a savvy and esteemed investment advisor, Madoff attracted a steady stream of clients, cultivating a sizable and devoted following along the way. However, while projecting an image of success, Madoff was clandestinely operating a Ponzi scheme behind the scenes. A Ponzi scheme, a form of fraudulent investment, operates by paying returns to initial investors using funds from newer investors. It relies on a continuous influx of new investors to sustain returns, ultimately collapsing when the stream of new investments diminishes. Madoff's Ponzi scheme was remarkably sophisticated and intricately concealed. Employing fabricated account statements and other deceptive tactics, he misled investors into believing they were reaping steady returns on their investments. In reality, Madoff was utilizing funds from new investors to satisfy the demands of earlier investors while enriching himself in the process. The revelation of Madoff's Ponzi scheme came to light in 2008, when he failed to fulfill redemption requests from investors. The collapse of Madoff's scheme unveiled the extent of his deception, revealing that he had defrauded investors of billions of dollars. The Ponzi scheme orchestrated by Madoff had dire repercussions for his investors. Many individuals who had entrusted Madoff with their savings saw their life savings vanish as a result of the scheme. Charitable organizations and financial institutions were similarly affected, with some being forced to close their doors due to the financial devastation wrought by the scandal. Overall, it is estimated that Madoff's Ponzi scheme led to the loss of billions of dollars for investors. Following the Madoff investment scandal, legal actions were taken against Madoff for his fraudulent activities. In 2009, he pleaded guilty to charges of securities fraud and other crimes, receiving a sentence of 150 years in prison. In the aftermath of the scandal, Madoff's victims pursued legal avenues to recover their losses. Numerous lawsuits were filed seeking compensation for the damages incurred. While some victims have managed to recoup a portion of their losses through the legal process, others have found themselves with limited recourse. The aftermath of the Madoff investment scandal reverberated throughout the financial industry, profoundly affecting investor trust and market stability. The sheer magnitude of the Ponzi scheme, one of the largest in history, rattled investor confidence and triggered a downturn in the stock market. Moreover, it prompted scrutiny of financial industry regulations and the roles of investment advisors. In response to this crisis and others, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in 2010. This legislation introduced new regulations aimed at safeguarding the financial system, including the establishment of the Consumer Financial Protection Bureau to shield consumers from financial fraud. The Madoff investment scandal was not an isolated incident, but rather a part of a larger pattern of financial misconduct during the early 21st century. Other notorious scandals, such as the Enron scandal and the LIBOR scandal, also involved deceptive practices to deceive investors and inflate profits. However, what set the Madoff scandal apart was the staggering scale of the Ponzi scheme and its profound impact on individual investors and charitable organizations. It's essential to contextualize the Madoff scandal within the broader cultural and economic landscape of the time. The years leading up to the 2008 financial crisis were characterized by a pursuit of short-term gains and a belief in the infallibility of the financial system. This mindset may have contributed to Madoff's actions and investors' willingness to overlook warning signs. The Madoff investment scandal reverberated throughout the financial industry, leaving a lasting impact that endures to this day. The collapse of Madoff's colossal Ponzi scheme, among the largest ever seen, served as a stark reminder for investors, regulators, and the financial sector alike. This debacle underscores the vital essence of exercising due diligence and maintaining a healthy skepticism toward seemingly miraculous investment prospects. It underscores the significance of diversification in investment portfolios and the necessity of spreading risk across various assets and advisors. Moreover, the scandal underscores the pivotal role of robust regulation in thwarting financial fraud. By implementing stringent oversight measures and learning from past mistakes, we can strive to build a more transparent and accountable financial system for the future.